Per usual, everything on this channel is for educational purposes only and is not intended as financial advice. It's Macro Monday. Let's take a look at the flows report from James at CoinShares. Minus 600 million on the outflow side last week, which he attributes to a hawkish Fed dot plot, hawkish SEP. Based on the rest of the market, the non-Bitcoin, the legacy side, the TradFi side, that market doesn't really believe Powell. That market, based on how it's moving, looks like shorter for longer. It looks like rates coming down rather than up. Very, very bullish on the TradFi side today. We did have outflows across the board aside from IBIT, BlackRock. Still seeing small inflows last week. Ethereum also saw small inflows last week, probably thanks to the ETF approval expectations or launch expectations. And globally, mostly outflows aside from Germany and Australia. Looking at the 30-day cumulative flows, we're still quite high on the 30-day, but again, this needs to be taken into context with the basis trade and all that other stuff that's going on surrounding the ETFs. But green is green, so we'll take it. If we look at the open interest, like I talked about last night, down slightly week over week. Basis still remains at 10%. Now, if we look at ETH, they also have ETH on here. ETH CME OI near all-time highs, and the basis on ETH is much smaller. This may explode after the ETFs get launched. It may not. It may also get individuals or entities involved in basis trading there, and then you may see flows coming in that aren't directional flows, but ARB flows, right? So just like BTC, you sort of need to pay attention to what's going on the basis potential for those products. Looking at BTC today, we had quite a bounce, matching the lows from the other day, not quite hitting the key June. I really hope this isn't Saylor, and that's going to sound counterintuitive, but we need people buying other than Saylor. So I really hope it's not him. It feels like him because the rest of the alt markets still are obliterated. They're in a pile of rubble today. Nothing on the alt side really reversed. ETH is still negative on the day. So this is very much a Bitcoin only story. Again, makes me believe it's probably Saylor. So now we get to see the reaction to the announcement that Saylor has already bought, and then people are going to be like, oh, this is so bearish, he's already bought. Whatever. Trend still remains above the cloud, still bullish. MSTR still bullish, much like BTC at 72. MSTR needs to get above 1700 for people to care again, but based on the cloud, that looks very, very bullish. And then if we look at BITX on the 4-hour, not quite fully bullish on the 4-hour yet, but that would be something else to watch. If, for instance, Legacy pulls us up kicking and screaming, which at this point somebody needs to get us out of this slump and funk, because we don't seem to have that ability on our own here on the crypto side. Something else you will probably see headlines on or people talking about on Twitter is hash ribbons. They will likely flip from bearish to bullish over the course of the week. Historically, that has been a pretty decent bottoming signal in a bull market, and all the hash ribbons is the 30 and 60-day moving average on hash rate. And you can see here on the purple and blue lines, these are likely to flip bullish. And why this matters historically is because when we see hash rate falling off a cliff, it's usually miners capitulating in some fashion, and typically that means BTC being sold by miners. Not necessarily publicly listed miners, but an aggregate on the network. Clearly there's something going wrong with hash rate. Going wrong meaning falling, right? It's not continuing to rise, likely for profitability reasons. Before I go any further here, let me mention today's video sponsor, Kraken Pro. Kraken Pro is a complete overhaul of the Kraken trading experience with a one-stop shop for advanced and professional traders. Kraken Pro enables efficient trading execution across multiple markets with a UI that allows for unique optimization tailored to your trading style. You can check out Kraken Pro with the link in the description of this video. Not investment advice. Crypto trading involves risk of loss. Cryptocurrency services are provided to U.S. and U.S. territory customers by Payward Ventures Inc., PVI, DBA, Kraken. Looking at Bitcoin, even on the 4-hour, hasn't really been too fun to trade this directly. It has been very noisy. There's been a lot of chop, obviously. The last real deal pattern we probably had was the inverted head and shoulders that we had down here. Since then, I guess you could have called this an inverted Adam and Eve, but all in all, there really hasn't been that much to do on low time frames. I typically like to go to Bollinger Bands or some other non-trend metric, because clearly we're not really trending. We're just ranging. We're flat. So it's going to take additional bearish pressure or bullish pressure to get us out of this range. And we're just here sort of indefinitely until we see something one way or the other that may be bullish legacy pulling us out of this, bullish ETH relative to ETF stuff pulling us out of this, bearish DXY pulling us up, bullish DXY pulling us down. I'll talk about it in a second, but what's really not helping is we are not the fastest horse in the momentum game right now. We are not the fastest horse. Haven't been this year relative to semis and NVIDIA and SMCI. So we kind of need a mix of sustained buying pressure and something to cold start this engine. You know, we need some speculative momentum to get bigger money to start paying attention to us again, right? So we're not quite there yet on price action. Just very boring. Looking at the calendar this week, a bunch of Fed speak. We have no trading Wednesday for Juneteenth. It's a holiday. And a bunch of economic data, nothing that I would consider super important, but I'm sure some of this is going to indicate whether or not we are more or less inflationary this week or this month, last month than we were the month prior. Next week, though, is PCE, which is a big deal for the Fed. Looking at CPI, based on the Trueflation data, we are still hovering at 2.2, 2.1%, which is where we want to be. If we look at the month-over-month change here, this was June 1st. So far we have seen a decline in Trueflation CPI from 2.31 to 2.18. Even in the UK, they are seeing declines here. Now this is stable. It's higher than the US inflation, but it is stable compared to where they were a year ago, all the way up at 13%. If we look at the US nowcast by the Cleveland Fed, they are projecting a 3.15 CPI. There's only 17 days that have gone by in this month so far, but that is certainly going in the right direction still. Are we there yet? No, we're not there yet, but we're headed in the right direction. Same thing with PCE. PCE between last month and this month declining, core rising, and it really depends on what the Fed wants to do. They can slice and dice this however you want. You could say super core is this, core is this, whatever is this, and you can get whatever number you want. But we are headed in the right direction. You can also say the 3, 6, 12-month average, whatever. We're still headed in the right direction. Looking at the categories that are hot still, motor vehicle insurance, tobacco and smoking products, the vice tax, if you will, vehicle maintenance and repair, hospital services, energy a little bit, owner's equivalent rent, primary rent, food away from home. So that's the main stuff that is still quite hot, and motor vehicle insurance is absurdly hot on a year-over-year basis. On the other end of the spectrum, the used car and truck prices coming down. That's the Manheim survey. You can see that before you get the data here. Airline fare down, dairy, milk down, new vehicles down slightly on a year-over-year basis. These aren't negative prices that are down, that are coming down necessarily. These are just negative on a year-over-year basis. Month-over-month change, tobacco and smoking products, quite expensive, medical care up there as well. Gas way down, airline fare way down. And just as Liz points out here, this is the month-over-month motor vehicle insurance, and this is something everybody has to pay for legally. And it only gets more expensive if more people aren't paying. It gets more expensive with more destruction of cars, whether that be from accidents or weather, acts of God, that sort of thing. So it's certainly a relief to see this coming down, but it's obviously not anywhere close to where it was in 2021. And it's got a long ways of negative months to burn off multiple years of rising prices. Like I was saying with core, super core, PCE, with CPI X shelter, you can get a value that satisfies the Fed and has satisfied the Fed for over a year now, right? Under 2%. Most people would say this makes no sense. Obviously, everybody needs a place to live. That's at the bottom of Maslow's hierarchy, just above Wi-Fi. But you can massage the statistics any way you want to get a value you want, to tell the narrative and story you want. Looking at the Fed meeting probabilities, the next meeting isn't until the end of July, so we'll get quite a few more data points until that meeting. And depending on how this lines up, just like we had CPI last meeting on the same day, we may get unemployment numbers on the same day of this meeting. I'd have to check. But unemployment's usually at the end of the month. And we're still pricing in at least one cut before the election, by the looks of it, or by the election, around the election. 2 cuts priced in for the year, 1 cut in September, 1 cut by December. And that's certainly going to juice markets even more. And if we look at the 2-year note against the Fed funds rate, historically, the 2-year note tends to lead, the 2-year yield tends to lead Fed funds rate. You can see how during the ZIRP era, 2-year yield was telling the Fed rates needed to be higher. Rates needed to be higher. So up here, it's telling the Fed rates probably need to be slightly lower than where they are now. So more evidence that the market is trying to tell the Fed and trying to price in rates slightly lower than where they are now. Looking at yields in the yield curve, the front end continues to remain elevated. We continue to be inverted on the yield curve. 3, 4, 6 month is the highest point in the curve, the belly of the curve. The lowest point and the long end slightly above the belly here, but that's been all over the place over the past 6 months. No signs of uninversion just yet. Looking at rates against unemployment and the yield curve inversions, I've been saying this for probably as long as this curve has been inverted. It's not the inversion that kills you, it's the uninversion that kills you and is a sign of the recession. Typically, we also have the Fed cutting ahead of the recessions, at least the NBER defined recessions. We typically do not have a soft landing. And so this is where people get the idea that all Fed cuts are bad, because that typically means they're cutting from a place of weakness rather than a place of strength. And thus far, it looks like they'd be cutting from a place of strength rather than weakness, so long as unemployment doesn't explode above 4%. Now, if we look at some of the data from DRW, they're basically kind of saying the same thing that the SOM rule would say, where if we have this slow tick, 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 tick up in unemployment, that eventually we hit a tipping point where there's just no return and unemployment continues to explode. They're looking at 2007, 2001, 1990. And so I think the real question is going to be, can unemployment be kept in check if they wait until September or December to cut? How bad does unemployment have to look for the Fed to finally start cutting? How good does inflation have to look for the Fed to finally start cutting at least once to try to get ahead of this and prevent an explosion in unemployment? Looking at GDP, we don't have an updated GDP now print until tomorrow, but currently we're certainly not in recessionary territory as defined by the NBER, and why would be? We're spending a ton of money, we have a ton of debt, so we'd expect GDP to be positive. Liquidity from reverse repo has actually continued to slowly drain a little bit here, not a ton, but on a day-over-day basis, you can see it's slowly coming down here. Over the past 3-4 months, we've just sort of cruised at this low level. If we zoom way out, you can see how much we've drained and brought back into the markets effectively by buying short-term debt, allowing yields to remain low-ish relative to where they would be otherwise, and allowing this money, instead of money out of risk, to buy those short-term treasuries. So if, again, the Fed is looking to time a cut with the reverse repo draining to zero, unemployment getting out of control, inflation just barely getting near the target range, listening to the 2-year yield, that sort of thing, then I think we're about there in the wheelhouse, at least within the next couple of months. We will certainly be about there in the wheelhouse. And this 2-year yield chart kind of begs the question, do we need the Fed? Shouldn't we just use the 2-year yield as the interest rate? Isn't that what it should be? I mean, it's been arguably correct most of the time. So if we did end the Fed, there's a pretty good case to be made that we would just use the 2-year yield as the interest rate. We've also benefited on the risk side from energy getting tamped down. That has reversed over the past week. It's up quite a bit in a week. And there's kind of been this inverse correlation to NASDAQ a little bit. There was an extended period from December to April where that certainly wasn't the case. But something to watch for is if oil peaks its ugly head again and starts getting closer to 90, what does that mean for risk markets, inflation, that sort of thing? Biden has already said he's ready to reopen the US SPR despite slowly refilling it on prices in the 70s. So if anything, this may act as an additional passive bid on risk markets because it's keeping gas artificially low, or for the purposes of re-election, low, right? Now, I have zero doubt in my mind Trump would do the same thing, so I don't think this is a Biden versus Trump thing. I think Trump would have just drained it to zero already and been done with it. But that will act as a further tailwind on risk markets. Looking at XLE, This thing is a failed breakout at this point, but it does have an interesting falling wedge type of structure here, and it may find support on the cloud on this diagonal. This is the energy sector ETF. And what we don't want is this resurging. We don't want this exploding to new highs. That would mean the inflation trade, the reinflation trade is on. Another reason risk assets in the US have had this tailwind is because everywhere else around the world is kind of having issues. The Eurozone, Japan, yes, their markets are at their own respective all-time highs or near all-time highs, but the safety trade is US assets, US companies. And this is huge outperformance, and it looks like that's going to continue this week relative to global markets. Looking at the S&P, cloud looks fine. We're just slowly melting up, right? We're just continuing at a faster pace even than the beginning of the year to just push and shove higher into this old cup and handle target between 5,600 and 6,100. And I don't know the stats on this, but it's going to be really interesting if Biden doesn't get reelected when gas is at X price, S&P is at Y price, and inflation is at whatever level it's at. Ultimately, I think inflation and loss of purchasing power is terrible for an incumbent. So if there's anything that's not going to get him reelected, it's that. But you wouldn't know it looking at the stock market. Stock market is continuing to make continuous all-time highs. QQQ, all-time highs. Again, huge, not like, not a sneeze, not a slight chuckle. We are talking about massive, massive moves higher. This is the QQQ cup and handle target. Basically 500 to 550 would be the level to watch in that previous consolidation. And this is another part of the issue. This is Mag7 against Bitcoin and ETH over the past year. Mags is a equal weighted ETF. So it's kind of the worst representation of the individual items in the ETF, but it's still doing quite well. It's doing quite well since its inception late last year. And a lot of the momentum, a lot of the attention is on the Mag7 stuff. Of the Mag7, most of it is at or near all-time highs, just slowly creeping higher, creeping higher. The one that has a decent setup remaining would be Tesla, and that's because it's down considerably on the year. At least it was. I think 37% might have been the max drawdown, something like that on the year. And now it's established a bit of a foothold in the daily cloud, some type of inverted head and shoulders here. Still has a chance to continue higher, has a chance to break out of the cloud. Elon's kind of a radioactive waste of a person from a headline risk perspective. So there's that. But the market seems to like the stock here, and it looks like the bullish reversal should continue. The rest of the tech sector, this is XLK, and again, it's just continuous reconsolidation higher, reconsolidation higher. One of the reasons why cup and handles are so bullish is because you get buyers and sellers coming back to an equilibrium, and then buyers take over again. So we've had a series of cup and handles, we've had a series of inverted head and shoulders, and it's just continuous all-time highs. And there's also such an imbalance here based on the weightings that NVIDIA is going to get 20% weighting and Apple's going to get demoted. So if you're trading this stuff, you definitely have to know what you own, and it's worth looking at the holdings and what they're doing there and what the rules are in the prospectus. But more and more, it's looking like it's live by NVIDIA, die by NVIDIA. And so long as NVIDIA remains bullish, anything holding NVIDIA will be bullish. This is the software ETF IGV, and this looked pretty dire a couple weeks ago. It's pulled up nicely, trying to cancel this head and shoulders. Never really confirmed as a head and shoulders, but it looked like it was ready to break down. And this is what you want to see. You want to see bearish chart patterns get nullified, get invalidated, get negated for a push higher, and there's a lot of Microsoft in here. That's certainly helping move that higher. If we look at Microsoft against the election odds, and I got to think miners are similar, Bitcoin miners. Bitcoin miners doing extremely well, continuing to do extremely well. And Jeff here sort of arguing that Microsoft stock price is just the live betting line on Trump's probability to win, because he will likely be less active in the regulatory realm when it comes to getting in the way of NVIDIA stuff, or AI stuff rather, I should say. And US Bitcoin miners, probably very similar. Trump has sided with them wholeheartedly. This is SMH, semis ETF. Huge all-time highs, continuous all-time highs. This thing just continues to blow away everything else thanks to NVIDIA. And we've got Supermicro rumored to potentially get added to the NASDAQ. This is SMCI. And the question I had is, okay, is SMCI going to also split as part of an announcement? On the daily cloud, this is a bullish Kumo breakout. So that looks great on the daily. It looks great on the 4 hour. It's trying to fully flip bullish on the 4 hour. It certainly spent plenty of time consolidating, plenty of time trying to break down and failing to break down. So this might be the next trade as NVIDIA maybe starts to slow down. But this looks primed and ready to go. And here's the real issue with everything relative to crypto is it's doing better than ETH, BTC. SMH is basically trading slightly past year to date, equivalent to BTC and ETH. And then you've got NVIDIA and SMCI 2x to 3x outperforming crypto, which is wild. This gap could close. I think it will close. I think we will eventually break up here and be higher on the year. But are we going to gain another 100% to match NVIDIA? I don't know. That's going to be tough. But there's certainly a lot of attention on semis still. As far as miners are concerned, they continue to look great. As I said, daily cloud looks great. If anything, they're a little overstretched here. We're at multi-month highs. We've got volume still at these levels. If we pop a pitchfork on this bad boy, maybe something to watch for would be, I don't know, 28 plus, 27 plus into this danger zone on the pitchfork here in the near term. But so far so good on WGMI, which is the Bitcoin miner ETF. This is WGMI against Bitcoin, and maybe the trade isn't paying attention to the USD value at all. Maybe it's just relevant to look at the Bitcoin pair. And we just passed the midline on this down channel that we've had since inception. So as much as miners continue to confuse me being more bullish when Bitcoin's bearish, maybe that's an AI trade, maybe that's a regulatory trade, maybe that's the Trump trade, I don't know. The Trump premium, but it's miners doing very, very well. IREN coming to the top of its, we're doing power rankings now. So IREN has done incredibly well. Huge breakout in the daily cloud over the past couple of months. And this is a great example of how many sort of false starts IREN had over and over and over again, and then finally got the move. That's why I really like pitchforks or trend channels paired with trend indicators, because it can really give you a sense of, okay, where's my maximum wiggle room here on the downside? In any event, we are approaching the top of this trend channel and tons of volume coming in. So we kind of have a little bit of a parabolic blow off potentially here. You know, I don't want to be bearish on anything, but this has moved very, very swiftly in the past couple of weeks. WULF, another one that's done very, very well. Consolidated at the cloud for a long time, did a whole bunch of nothing for a long time, then just exploded higher thanks to guidance on hash rate. Huge volume coming in here, nearing its logical TA target. So much like IREN, it wouldn't surprise me if this also slows down, but it's done very, very well over the past couple of weeks. CleanSpark on the other side of that coin, where much like Coinbase, it has consolidated for a considerable amount of time here. It's at the midpoint of the pitchfork. It's getting back above the cloud, bullish TK cross pending. We may see CleanSpark start to pick up again and take over and lead WULF and lead IREN, just because those have moved up so much over the past couple of weeks, where CleanSpark has just been ranging for months at this point. So this chart looks very good to me. Pre-breakout, you're even breaking out of this diagonal resistance. Upside targets there, I don't know, 30, 28 plus certainly by the end of the year. Looks very good on that front. And CIFR may be the hidden gem here of them all. Very tight consolidation, coiling. I don't know anything about this business or their hash rate or anything like that, but TA-wise, this does look very good. Does look ready for basically a 2x from here, potentially. And I gotta think at some point, just because IREN and WULF have been overperformers, so long as the business end of CIFR is on the up and up and they're mining as they should be, we should see some rotation, probably, or some catch-up trades in some of these sooner rather than later. So I think CIFR would be the next one to watch. Now, the rest of them, just kind of middling, meh, hut. You could probably argue an ascending triangle on this as well. Looks okay. Certainly looks better than Mara, which just continues to look like dead money here. Huge, huge, huge range. Whole bunch of nothing. And there's a lot of like tribalism with the miners and people like one versus the other, but I would just be objective here and say, look, CleanSpark looks ready to go. Mara does not. IREN and WULF have already given you a 2x trade. CIFR would make sense to move on a percent basis more relative to those other names. So I would just think about it like that. RIOT's another one. Why are they trying to take over Bitfarms and not shore up their own house first? This this chart looks abysmal. What is going on here? What is going on here? I don't understand. I don't understand. You could say, well, maybe Adam and Eve, but just an ugly, vicious range for almost over a year now. It's been just doing nothing. Like, why should I care about RIOT at all as a trade, as an investment, if it's just done nothing, gone nowhere? What do you even do here? Bitfarms, maximum bullish upside potentially would be getting back into this pitchfork. I don't know, 6, 7, 8. I doubt 10, but again, I don't know enough about the business side of these miners to where it would make sense for them to even pull this off. So I would look into that further. But if I'm being incredibly optimistic, it would be a return to the midpoint of the pitchfork, if that's even possible, for Bitfarms. Then lastly, HIVE also just looks kind of middling, unexciting, trendless, range-bound chop. So all in all, TradFi looks great. A little stretched, sure, but there's plenty of stuff to do that isn't Bitcoin right now, unfortunately. And until that stuff slows down a little bit, or we start to see some rotations between semis and software and Mag7 into BTC via ETFs, TradFi probably continues to outperform. That's all I got for this one. Like, dislike, comment, share, subscribe, and happy trading.